My name is Jeremy Harbour. Over the last 30 years, I've built and sold many different companies. I've done startups, I've done buy and sell. I wrote the book Go Do, which is how to get started in business. It was a #1 bestseller on Amazon in 2012. I also wrote the book Agglomerate, which is how small to medium-sized businesses can collaborate together and take on their larger competitors by using the public markets to list themselves. And I've helped hundreds of entrepreneurs buy and sell their companies. I've personally done around 50 transactions. I've probably advised on a couple of hundred more. And through my experiential boot camp, the Harbour Club, I've trained hundreds of entrepreneurs on how to buy and sell small to medium-sized companies. Now, it's the small to medium-sized company sector that really interests me, because all the politicians listen to are the top 1% of companies globally. These are the large public listed multinational companies and the banks, and they kind of control the political will, the thinking, the taxation, and a whole raft of things like this. But what's really important to know is that 50% of GDP in most developed economies actually comes from companies who employ less than 200 people. And most people, 98% of the private sector workforce, also work in these companies that employ less than 200 people. So actually it's the SME that's more important than anyone. And yet the SME is pretty much, from a corporate finance perspective, left to rot. They can't access capital for growth, they can't access debt from banks. All of the money is basically sucked into that top 1% of companies, and a little bit of it is distributed to startups. But startups are incredibly risky. You know, the fintech world is a prime example. It's a really exciting space, and it's definitely going to change the world. But there's going to be very few that actually make it through. Very few investments that I think will work. I think it's far more interesting to focus on the companies that are already successful. They've already created jobs, they've already solved problems, and they're generating money right now from solving those problems. These are the small to medium-sized companies that are professionally run, they're profitable, they're debt-free, and they've been producing profits year on year, you know, for the last few years. Now, why is it that these businesses find it so challenging? Well, it really boils down to 3 reasons. You see, all of the money in the world is kind of stuck in either equities, debt, or derivatives. Now, the equities market is around 30 trillion, the debt market is around 70 trillion, but the derivatives market, which is pretty much bets on things. You probably remember from the 2008 crisis, we had these credit default swaps. They were a great example of a derivative gone wrong. But the derivatives market is estimated to be 10 times global GDP. That's in the quadrillions of dollars per year. So all this money is basically being bet on stuff when there are all these great companies that are generating real profits. And the reason for that is that these companies are basically, they suffer from 3 key problems. They're basically too risky. If they lose a couple of key employees or they lose a couple of key clients, it's their worst year ever, and it could be their last year ever. They suffer from scale, and I don't mean scalability. You'll hear a lot in the kind of fintech world about having something that's scalable. Well, having something that's scalable is only part of the problem. You kind of have to be big to get big. Until you're already a large business, you can't win the big contracts. And this is why banks are such a threat to fintech, because they've already got the scale and the licensing and the customers to be able to drive these products and services into their customer base far more efficiently. So we really have to gear ourselves up if we want to compete against these larger organizations. So I call it the scale paradox. You know, you have to be big to get big. And then the final one is liquidity. When you're looking at an investment, it's really important that you can get your money back out again. And when you invest in a public listed company, it's very easy to sell the share again tomorrow. When you invest in a private company, you really have to wait for that entrepreneur to want to sell his company. And that could be a 5-year plan, a 10-year plan, or, you know, with the best will in the world, the 5-year plan can become a 10-year plan. So having that lack of liquidity basically keeps all of the global capital away from these small to medium sized businesses. So we came up with a solution we called agglomeration. And agglomeration is basically putting a number of these smaller companies together So you effectively create a group of high-performing entrepreneurs with a group of businesses that are all profitable, that are all debt-free, and that are all in the same business sphere. So they're all in the same market, but they can be spread across different countries. That way you solve the risk problem because you're now diversified across countries, across currencies, across products, services, markets. You solve the scale problem. You now have a big P&L and a big balance sheet you can point to show that you can punch above your weight on the global stage. And you have liquidity because you list this group of companies on the public market. So you effectively have shares that are publicly traded. And the discount between a large public company and a large private company is about 30%. So there's a huge increase in value just by having that liquidity. You can call it a liquidity discount, if you like, on the private company. So the difference between the large public company valuation and the large private company valuation is about a 30% difference. But the difference between a small company valuation and a large public company valuation is many times over. It can be 5 or even 10 times the difference in valuation. So that creates a huge amount of shareholder value when one of these small private companies becomes part of a large public company. So this is really the heart of agglomeration. It's creating huge amounts of shareholder value for small to medium-sized business owners. Now these guys are out solving problems every day and they get rewarded for solving those problems. They get financial benefit from solving those problems. But over the longer term, they don't really get the same financial benefit as the large public companies. So really, by closing this gap between small company and large company valuation, we also have a really good opportunity to democratize wealth. I think we have an opportunity that we can effectively take hundreds of thousands of entrepreneurs and make them wealthy through the process of agglomeration. And what that does is it creates wealth that's meritocratically earned. So you add value to society, you get rewarded, you become wealthy. And I think this meritocracy bit is kind of missing from the current global financial landscape. We always hear lots about inequality, but politicians only seem to have one answer to inequality, which is to take money from people who work and give it to people who don't. And that doesn't necessarily create an environment that encourages people to go out and add value to society and change things. And I really think that through agglomeration, we can reconnect that reward for work and reconnect wealth to value creation. And thereby create a generation of wealthy entrepreneurs who will effectively inspire the next generation to get off their arse and do something. But also, if you look at new money, it tends to be where all the philanthropy comes from. You know, once entrepreneurs have solved money, have made money, they're instinctively problem solvers. They just go on and solve bigger problems. If you look at what Larry Ellison is doing for cancer research, or Bill Gates for malaria, or Mark Zuckerberg for female equality, you can just see what happens when these people do break through. But unfortunately, these entrepreneurs are the exception, not the rule. They're kind of the lottery of entrepreneurship at the moment. And I think we have an opportunity with agglomeration to spread it a lot wider and a lot thinner, and effectively have a crack at solving inequality through this agglomeration structure. Okay, so our first agglomeration was the Marketing Group PLC. You can see the ticker online. It's tmg.st or tmg.ss, depending which system you're looking at. It was listed on the NASDAQ in Sweden. It's a group of marketing services companies. We learned a lot of lessons about the model by doing this. I mean, it proved the fact that this decentralized approach works really well, and it also proved that the ability to create shareholder value through putting these companies together works incredibly well. In fact, in the first 90 days, we grew from 4 subsidiaries in 2 countries to 17 subsidiaries, and we're spread across Australia, New Zealand, Singapore, the UK, mainland Europe, and the US. So those 3 factors, the risk, the scale, and the liquidity, have all been addressed within the Marketing Group PLC. The big lessons we learned was really around trying to manage the 25% free float that you have to have as a public company. So 25% of the company needs to be in public hands. Now, some of that is done through an IPO, an initial public offering, and some of it's normally done with institutional placements. Unfortunately, it was very hard to get institutional interest because this is a very disruptive and different model, and actually it disintermediates a lot of banks and a lot of corporate finance companies. So they were pretty upset about this potentially being successful. So it was very hard for us to find institutional backing. We did find an institution that would also provide us with some finance against some of the shares, so effectively give us some cash to enable us to accelerate the model further. And this was one of the traditional kind of Wall Street type finance companies. Unfortunately, because it was the traditional finance industry and what we were doing is very disruptive, is they decided to try and destroy the model, and the 3 million shares they were holding as collateral, they sold into the open market. This was completely against the agreement we have with them. It was completely against all of the communication we have with them, where they were promising us they weren't actually doing this, right in the middle of actually doing this. But I guess this is why everybody is so excited about fintech, because we suddenly have a chance to get rid of these people, that we don't have to deal with these greedy, short-term, traditional institutions. So basically the challenge was, with all these extra shares coming onto the market, it damaged the share price. By damaging the share price, it damaged normal retail investor confidence, and now the share is trading at a much lower level than when we first listed, even though huge amounts of value have been created. So when we first listed, we listed at €1. We went to €9 as we did more, acquisition upon acquisition. After this toxic finance experience, we're now trading at around 50 cents. So there's a huge value opportunity that comes with that. So I believe right now TMG is undervalued. It is effectively trading at a big discount. I don't think the market will keep that discount forever, but right now I think it represents a big opportunity. Effectively this is a group of profitable debt-free companies that's diversified. It's diversified across countries and across currencies. It's still acquisitive. It has a great pipeline of potential new acquisitions. It's got a great management team. The chairman of the company is the ex-chairman of a FTSE 250 listed company. The CEO has worked for some of the largest marketing services companies in the world and has a great vision for the group. We believe that the shares should be trading many times their current price, and we think that there's a really big opportunity for investors there right now. And then in addition to TMG, we have another 3 agglomerations listing this year. So the first one is in the childcare space. It's called Lara Group PLC, and it specializes in early years education, which is a very fast growing area. It's an area that benefits hugely from the demographic cliff. As populations age, childcare becomes a more important aspect, because you need both parents to be going to work. There's a huge underlying trend around female empowerment as well, which childcare is one of the biggest enablers of equality in the workforce. So the whole childcare sector is a very interesting one, and it's ripe for agglomeration because it's so fragmented. There are no really clear big players in that space. In fact, the top 20 in the UK, for example, only have around 10% market share between them. So we really think there's a good opportunity there to create that strong global player in the childcare and education sector. We then also have Telefed PLC. This is a group of cable TV, IPTV companies, mainly focusing on emerging markets, or New Europe as it's sometimes referred to. But basically, again, we're targeting areas where the business is incredibly fragmented. If you're in the UK, you have a choice of 2 cable TV providers. If you're in Bulgaria, you have a choice of 500. If you're in Poland, you have 600. So these countries have incredibly fragmented cable TV provision. That means that they're overpaying for their content. They can't negotiate good content rights. It's very hard to roll out new technologies because they don't have the scale to be able to soak up the capital expenditure across a very wide audience. It's just a very interesting marketplace. It has a fast-growing middle class. It has a much better demographic than the rest of Europe. In fact, in most of those emerging European countries, most of the population are under 30, whereas you go to somewhere like France or Germany or the UK, and it's completely the opposite. So again, we think this is a very interesting area to go and do an agglomeration in. And then we also have a property services company. Again, the property services space is dominated by a number of really big players, but there are literally hundreds of thousands of small players. So the disparity between the very large companies and the very small ones is huge. So we really think there's a great opportunity to effectively gather together a group of the better small companies, put them together and become another big global player in that property services space. So why are we doing an ICO? Well, in every company that we list, we have to have 25% of the company in, outside of our control. So effectively in public hands. It's kind of the definition of a public company. And we've already realized that we don't want to give the traditional finance industry a look into our disruptive model. So effectively, we want to create our own institution. We want to have our own business that invests in into agglomerations and effectively democratizes wealth to investors as well as democratizing wealth to the entrepreneur. So we have a company in Singapore which will be our holding company. This company is going to issue a token. It's going to issue 21 million tokens at $1 each, so $21 million in total. There will be a 1.5% of the money raised will be held in order to run the organization for 5 years, so the total costs. This will be transparently published in how that money is deployed, but basically will pay for the independent trustees, the audit fees every year that the company has to go through, and these sorts of things. And then the remainder of the funds that are sitting on the account will be deployed into agglomerations, and it will go in a number of different ways. So the first will be into TMG. So we have what we consider to be the fair value for TMG shares. And so this institution will buy shares at an average price of 50% of that fair value, up to a maximum of 40% of the funds held. So effectively, it will buy shares in the open market and off market with an average purchase price of 50% of what we believe the fair value to be, thereby leaving lots of upside for investors, also supporting the share price of TMG, which will enable them to do more acquisitions. And if they do more acquisitions, that creates more shareholder value and really helps make that business a great success going forwards. The balance of the funds will be deployed into the new agglomerations that we're launching. Now, when we do an initial public offering, when we do the actual listing of the company, we typically discount the shares to around 30% of what is considered to be the fair value. The brokers will tell us what the fair value for that company should be based on market comparables, and that's typically discounted by about 30%. We will take pre-IPO positions in those companies with a further 20% discount. So overall, there'll be 50% margin between the price that this institution will pay and the fair value of the company when it lists. Now, obviously, as soon as it is listed, it's going to be adding more and more companies, as is the standard model for agglomeration. If you remember, in TMG, we listed 4 and we very quickly went to 17 before we had that toxic finance incident. So we would very much be aiming to have that kind of trajectory for all of the companies that we do agglomeration for. So listing a small group and then very rapidly adding companies. But instead of stopping, the idea is to keep going, to keep building really large organizations. And every time a company joins, it increases the earnings per share. And every time we increase the earnings per share, you increase effectively the share value. So the idea is that we will continue to grow, as well as having this initial discount, we will continue to grow the share value relentlessly after the business is actually listed. So this holding company that we formed will hold shares in all of these different agglomerations. This company will be a major shareholder in each one of these agglomerations, and so its shareholding will be listed on the public register on the website for each of these companies. So it will be very easy to see that your company that you have this token issued in actually holds the shares that we say it holds. We will also be independently audited on an annual basis to demonstrate to people that the shares are still being held, and we'll have an independent trustee on the board of directors, which is a legal firm, which will also be responsible for ensuring that the company continues to hold the shares. We've also chosen to domicile the company in Singapore. And the reason for choosing Singapore is that it's also one of the highest compliance places to do business, and it also has a regulatory framework that's designed to protect investors' interests. So in terms of transparency, you'll not only have an independent trustee, an independent audit, we will also publish on the company's website the expenses that we have and also details of the shareholdings that we're holding. The beauty of this model will be that the shares that are held within the holding company can't be traded. So effectively it creates a liquidity squeeze on the public company. This helps support the share price because it's an institution that basically has a long hold position on these shares. However, the token that you hold is freely exchangeable, and you'll be able to trade these tokens between other people who want to trade them. So effectively we create almost a secondary market for the shares in these agglomerations. After 5 years, the token holders will have the opportunity to exchange their tokens for shares in the underlying companies, or for the company to dispose of the shares and return cash to the token holders. We will probably also have some kind of rollover opportunity as well if people would like to roll over their investment for a further 5-year period. But the plan at the moment is to have a 5-year closing date on the fund and to have all the funds deployed right at the beginning of this ICO. So in summary, there'll be $21 million, 1.5% of fees, and the rest will be deployed across these agglomerations at an average discount of 50% of the fair value of these shares. The shares will be held for a 5-year period and then be interchangeable for the tokens at the end of that period. During the entire period, the tokens themselves will be exchangeable in the open market.